Let me walk you through an actual call wall in action example. We've got Palantir Technologies here, and they reported earnings yesterday, and the stock went up, hit our resistance line and came back down. And it was actually rather predictable. Why? And we did predict it because you see that indicator here at $25. That green bar tells you that there are a lot of call options positioned for this week at $25. And how many? Well, you can drag your little call slider onto there. You can click on it. And now it shows you the open interest, OI, 21,000. 21,000 options control 2.1 million shares of Palantir. It's rather a lot of money. If you go out 1 week further, the next week, you see the same setup again, a massive amount of call options at $25. So again, you can check that out. And for next week, it's 68,000. So 6.8 million shares of SoFi controlled there at that point. You add those two together, you arrive at about 9 million shares of SoFi. And therefore, it's a very, very good call wall. Now, I'll put that in here as a resistance line just so you can see just how effective that was. And we hit it, we came back down. So let me show you the actual behavior during the day on a 5-minute chart here. So start of the day is here. The red line is our $25 call wall. And you can see we hit it here. What happens the moment we hit it? The next 5 minutes, we're selling. And you can see all the red sell-off volume that happens. That's sell-off pressure. What about the next time we hit it? We get a green bar up to get to it. And then we have a red one to sell off. We recover, we come back up, we get a red one again, and we sell off. Right? We go back above it, and you can breach them, often slightly, and then you come back down as the sales pressure kicks back in, and then we try it again more, because there was some actually good news on that day, some analysts coming out with upgrades or with sort of more positive spin on the stock. But as you peak, you sell off again, and even then on the end of the day, that massive green candle there, it's followed by very, very significant sell-off. And the stock does not make it back above $25 for the rest of the day. That's a call wall in action. Now, how does that actually work, you might wonder? Well, there is a little bit of theory to that. You need to understand a little bit about how options actually work. I'll give you a succinct, slightly simplified summary of it. If you buy a call option on this stock, Palantir, what happens? You are now bullish, right? So you have a positive exposure on this stock. And who sold you that stock on a liquid stock like Palantir? A market maker. We've got 3 of them on our team, so we understand the space very well. Has sold you the call. And therefore, the market maker is now bearish on the stock. So he has minus a call option, right? Now, a market maker, a MM market maker takes no risk really on the market. They are 100% hedged. So they balance their position. So the easiest way to think about that is, what does he have to do to get rid of the call option without actually getting rid of the negative call option that he holds? He buys 100 shares of the stock. So he's done that. So he now owns 100 shares of the stock. But what also happens is that you will sell your call option as you are making a profit. And that is presumably why you trade. Right? And therefore, the market maker sells his, call it 100 shares. What happens when you lock in those profits, you're actually depressing the share price. Now, it shouldn't stop you from doing it because you are trading for yourself, not for the greater good of the market. But in a nutshell, that's what happens. So when you get close to these call walls, the selling pressure actually kicks in, and that is bad for the stock price. So there are not infallible, but incredibly useful indicators, and you can get your hands on that indicator, of course, on optionswatch.io if you haven't already. It is a premium feature, but there is a 30-day free trial, so you can try it out and see if you get the value out of it that I think you get value out of. Now, this is most useful for stocks with large volume, liquid stocks, and it works also the other way around for support lines.